It's good to have you back. In this playlist, we'll tackle our most challenging challenge yet, which is the stock market. We're going to try to beat it using the power of stage functional programming and probabilistic programming. In particular, what we will be doing is building trading systems to do so. So, I do have a bunch of ideas that I want to try out, and I don't want to take the usual attempt that regular retail traders do. And what does that mean? Well, very briefly, even though it's possible to use moving averages, breakouts, and other technical indicators to great effect, I don't in particular want to do that. Instead, I have a much better idea in mind as to what we could be doing. And that is to represent the stock market more in line with how I actually think about it. Because if you look inside and really ask yourself, you are not really thinking about price movements in terms of moving averages or breakouts. Rather, what happens when I look at stock prices, for example, I see that there is a small number of very, very large moves. There is a much larger number of smaller moves, and most of the time is noise. So if we represent it as a graph, let's see, something like this. Okay, there's no need for the left side. So on this horizontal axis, this is going to be the average price. On the vertical axis, this is going to be the average duration of a particular move. And of course, the average price is never going to go. Let's say this is the duration of one. Let me write it out. This is actually very easy to understand. If you look at how professional traders actually work, they tend to, for example, if they go long and the price spikes up, they will tend to sell. And that's because the more intense the price movement is, the shorter it lasts. While if a stock, for example, is range bound, whether that be intraday or on the daily basis, that will last much longer than a sustained move. So this is what this graph represents. So we're going to have a bunch of probability distributions on this graph. For example, let's say we have one move that goes from here to here. This time we're going to simulate it. For example, we're going to have one move that goes from we're going to represent a slow uptrend using another probability distribution, and it's going to last less than a completely neutral distribution. Then we're going to have sorry about that. Not this. It's kind of annoying how it kind of keeps swapping these arrows. So, for example, we can kind of consider these as a moderately strong uptrend. This is going to be a highly strong uptrend. And this, for example, this could represent a capitulation move, like a very sharp move up that ends very, very quickly. And this average duration, these moves aren't necessarily going to be like of the same length. Like, for example, we can have a neutral move that lasts 100 bars, We could have a neutral move that lasts 70 bars, but that's going to be less likely that than it lasting 100 bars. It could also last for 200 bars, for example, and that's also going to be less likely than it lasting 100 bars. This average duration is like the expectancy of it lasting for 100 moves. And of course, on the short side, we're also going to have moves to represent falling prices. In other words, falling trends. And this one in the middle, for example, well, let's say it has a weight of something like 50. We're going to put all of these probability distributions in an array and give them a certain weight. And when you sum up the weights and then divide the individual weights by that sum, we're going to get a probability distribution. Let's say this 50 is like the weight for the average for the neutral distribution. This could be like 25, maybe let's say 15. This could be like 7. This could be like 3. So these very sharp moves, which last a short amount of time, are in fact, for example, this 3 is what 15 times less likely than 15, something like that. Let's see, 3 divided by 50. Okay, let me fire up. Okay, this is just my trading journal. I mean, it's public. You can find it on my GitHub repo. So let's see, 3 divided by 50. It's yeah. So this move is 6% as likely to occur as this 50, and it's going to be the same for the inverse moves, like. This is just what we're going to test out for the first try. Let's see. And what does this give us? If we make a program that generates prices based on this kind of probability distribution, it's this simply by itself is not going to be very useful. But what we could do is train a lookup table or even a neural network to predict the latents of such a program. What does that mean? Like, for example, if the program is in a neutral distribution, the program itself will know what distribution it's generating the numbers from, and that could be used as targets in a supervised learning setup. The same goes for this. For all of these other distributions, like this could be distribution 1, distribution 2, distribution 3, distribution 4, distribution 5, distribution 6, distribution 7, 8, and 9. And this label of a distribution could simply be a target, a categorical target in a lookup table. In a lookup table, we can just sum up we could just increment the counters. For that particular feature, in a neural network, we could use something like gross entropy distribution and use that to predict these labels. And once we train a lookup table using that, we'll be able to use it on real data, and we'll be able to use it to generate trading signals. And this is going to be most likely better than using moving averages, breakouts, or other technical indicators like relative strength index or Bollinger Bands. And this also has one other big advantage. For example, we could right now we see that all of these distributions are perfectly neutral, so that if you if you go long or short at the start of the simulation, and then hold for like 1,000 bars, then the most likely outcome is that you're going to break even. But for example, let's say we wanted to model a bullish scenario, we could increase the weights for these. Maybe not 45. But yeah, if we mess around with the weights, and we're going to be doing that later in an automated fashion based on historical data. That will allow our system to have a bias. And why is that good? Because, for example, if you have a rising stock that you know, let's say it goes up very rapidly. Imagine these are daily bars, and suppose it went up like 300% plus. Then it's very likely that it's going to sell off in on the next day from the open. Sorry, I meant to do something like this. It might open up and then sell off a big like this. Whoops. Yeah, like that. So we don't want to assume that it's as likely to go down as it is to go up, because when a stock is overextended on the daily chart, either to either to the downside or to the upside, it's very likely that it would mean revert. So for example, so we'll want different systems for when the stock is oversold versus when it's overbought. Like for example, if it was if it was like this, let's revert to how it was before. We want something like a positive system. Like let's see, this is 40, 30. Okay, sorry, I meant to say that we want a short system. So the short system should assume that the downside movements are likelier to occur than upside movements. And this is actually a very interesting thing if you think about it. We're going to be doing probabilistic programming. So instead of actually building a system, what we're going to be doing is building a generative process and then inverting it to actually get such a system. And to me, this is much easier to think about. And this is a much easier way to actually express an expectation of how the market acts. So I think this is going to be very interesting. One other thing is that this is incomplete, because we don't just want 9 different distributions. In fact, one thing that I did learn from Lance Bernstein is that even intraday there are mean reversion effects. Like let's say, let's suppose we have something like intraday. Okay, let's use negative bars. Suppose we have a large sequence of negative bars like this, this. And this is not a range-bound action. These are just a very large sequence of negative bars. And then maybe we could get something like a capitulation move. What I've learned from Lance is that you can actually use something like a 2-minute system that breaks the prior bar highs. And then what's likely to happen is that the stock will mean revert. and at some point it will stop going up and break the prior bar lows. And in fact, what Lance suggested, in fact, this is actually how he trades. He actually goes long somewhere around here. Whoops, not like this. Long here. And let's say, close that position here on the break of parabar lows. Of course, what he does is much more sophisticated. He tends to take partial exits. So close maybe close 1/3 position here, and then let's see. Maybe he would do something like close 1/3 here, and maybe if it continues maybe consolidating, maybe he'd close the rest here or something. Oops, sorry, meant to use that arrow. Close 1/3 here. And I'm actually pretty interested in implementing such a system. So what we have to do is actually implement state transitions. Like, let's say here we have a negative system, and we have to implement transitions. If we have this, then it will have to transition into this kind of system. Let me just strong negative price action mean reverts into okay, I'm going to do this part really quickly. Okay, so I changed it back to neutral, and what we have to do in order to maybe do this kind of mean reversion properly, we don't want assume that the entire move will be mean reverted, but if for example, if the EV of this move is like, let's say the EV is the negative, if the negative EV is -5, then the EV of this particular move here on the right side might be, let's say, the positive EV is, let's say, 2.5. So we're going to start with that kind of assumption. But let's make it at the start of the move. That's the best way. So what we have to do is basically the inverse of this. This is 7 here, so it should be like 3.5 here. This is 10 here, so it should be what 15 here. This is 30 here, so it should be 45 here. And this is 40 here, so it should be 60 here. And it's pretty interesting if you look at this. Now the positive moves are actually much more likely than even the neutral moves. So it makes sense to be long for the duration of this. So what makes probabilistic programming so appealing to me? It's because we can have a generating distribution and just slightly tweak it to get to get a completely different system. For this move here, like for example, we can kind of segment this out and think of it like a very negative trend followed by a shorter duration positive trend. But in reality is this could be generated by pretty much any kind of probability distribution, even positive one. Like, for example, this could be range-bound action. And, each of these, slightly negative bars and the strongly negative bars are going to have a certain probability of happening in all of these distributions. And the hard part is being rational about what particular distribution a particular move belongs to, because it's possible to have. Okay, let's maybe define a probability distribution for this. Like I'm going to define a little table here. This is the way that I've been imagining it. For the neutral distribution, of course, in the actual program itself, we are going to be sampling for a normal distribution, and then we are just going to discretize it to the nearest magnitude, something like this. But suppose we have a distribution, something like this. And then you can see that the very large moves are very unlikely to occur in a range bound market. When it's being sampled from this neutral distribution. And if we had something like a very intense distribution, like the one here, the probabilities would look completely different. Maybe it would be some. Sorry, I got distracted. Let's suppose we have a very intense upside distribution. So let's say this might be so in fact for a very strong upside distribution. In fact, this is. I wanted to write a negative distribution. So okay, let's see the. So this positive move will in fact be the least likely. And then it would be progressively more likely as it goes up, something like 16, 32. And then this part. Okay, maybe this is going to be a bit too strong, like realistically, because there's pretty much no weight on these other moves, and that would be that's something that we are going to cash out when we actually start generating real world. When we start to fit it to real world price action, so it more closely resembles it. And we have some price action. So now we have to actually, in order to actually do rational reasoning about these moves, we have to we have to do something like apply the Bayes rule. And if we apply the Bayes rule, we have to integrate over the entire probability space, and that will be pretty much impossible. So we're going to implement this simulator. Then we're going to do Monte Carlo rollouts on it. And we're going to use this. We're going to use those rollouts to train a lookup table. That's going to count for every particular feature in the table, how likely a particular move is to occur. And I think if we train various different systems for different kinds of probability distributions, that will end that might allow us to trade to mix different systems together. So let's say a trader kind of trades Lance's system, and he isn't sure where to take profits and close. I mean, he's sure to. He's sure in the sense that he has a very systematic system, but he isn't actually sure whether the system itself is right. So what we could do is maybe train a combination of a strongly bearish system, a moderately bearish system, and a slightly bearish system. So a strongly bearish system might hold a third of the position all the way up to here. A moderately bearish system would sorry. This is actually supposed to be a strongly bullish. No, actually, let's say this is a neutral system. And the neutral system would maybe hold up to here. A slightly bullish system would hold up to here. And a strongly bullish system would maybe hold up to here. Something like that. So each of these moves are going to have its own, maybe, in a sense, a draw table, or how a particular price movement is to occur. Is going to have its own duration, and we're going to be using a log normal distribution for that. And we're going to get a decent dispersal of various price moves. We need to capture mean reversion. We also need, in addition to just price action, we need we're going to have to do some analysis in order to figure out how volume affects the odds of a particular price action. If the volume is increasing, does that increase the probability of a move or not? Like, even I myself, I have a lot of experience watching price movements, and even I myself, I'm not really sure how volume affects price. So doing this kind of analysis is going to be very interesting. Yeah, there's also the seasonality effect, and typically when people talk about seasonality, they mean that some months in a year are more bullish than others, or something like that. But when I talk about that particular effect, I mean intraday seasonality. And as you know, intraday, okay, you tend to see that intraday, most of the volume is at the open, then it tends to fall off during the middle of the day, and then it goes up near the close. Open, close, average volume. Yeah, it's something like that. At least this is for stocks. If you look at maybe crypto tokens, as far as I could see, the volume is evenly distributed across every hour of the day. But in stocks, you have most of the volume near the open and near the close. Maybe it was like this. I don't know. I don't actually even know what the exact volume distribution is. So that's something that we're going to find out. And to write this probabilistic program, we're going to be using the spiral language like we have up to now. In fact, the overall program architecture is going to be very similar to to, to how it was when we were doing the poker game. The main difference is that compared to before, I'm not going to be using anything that involves linear algebra. Okay, let's see what DALI has to show for it. Pretty much every time I try to use neural networks or even very shallow models, um, in the past month we've been trying out various clustering methods, and whenever I try that, I get fucked over. So yeah, anything involving linear algebra goes into the trash this time around. I'm going to take it seriously, and I'm not going to be trying to cause the singularity in this playlist anymore. For the past decade, I've been struggling, trying to make deep reinforcement learning work. I mean, from the beginning, I knew that it wouldn't work well. But what I did think is that if I really, put in the effort and apply it myself, I would be able to find some kind of better algorithm that would make it work. And usually, in programming, that is the case. If I put in the effort, I get new insights into the problem, and I get new solutions that I couldn't imagine when I had started. But when it comes to neural networks and deep learning, that isn't the case. Everything I ever tried out is fucking trash. I would have probably saved years of my life had I never tried any methods that involved matrix multiplication. Instead, what I'm going to do is what I'm really good at, and what I'm really good at is stage functional programming. What I'm really good at is making these simulations, take a look at all of this. All of this is a masterpiece. The way I've implemented, for example, the tabular counterfactual regret here is a work of art. But all of that effort is always comes to nothing, only because there is simply no good algorithm for me to implement, and I cannot find one myself. What we're going to do is take this approach and apply it to the stock market, and we're not going to be using any, k-means clustering or deep learning or anything like that. Instead, we're going to be handcrafting features like we should have done for poker. We're going to make use of our strengths and implement all of these simulations on the GPU, so we are getting 10 times the performance that we would get compared to doing it on a CPU. It's going to be a really easy way of parallelizing Monte Carlo rollouts. We already have plenty of experience doing that before. Like in the previous playlists, we actually implemented tabular counterfactual regret on the GPU, and we also implemented the LIDAC and the no limit hold-on games. And that was fucking great. And I do regret that we never got to the point of actually being able to take advantage of it. If it wasn't for the stock market, if it wasn't for all the money that I made at my old Tau Ceti job, I would have probably just handcrafted the features and created a poker bot, and then This series wouldn't be building the trading edge, but building the poker edge. We'll be build some GTO bot. We'd get the data on how it performs and against the actual human players, and we train a bot to actually exploit humans based on that. But I have a decent amount of money now. Like, I'm not going to keep it a secret. It's $100,000 and actually euros to be more exact. So it's a bit more in dollars, and I want to take advantage of it. I've in the past decade, I've been a trader for like 6 years. I've paper traded for 4 years. Then I traded for 2 years with real money using a very small account, and I broke even. And when I gave up on trading and to go into programming, it was very heartbreaking for me. So what I want is a rematch with the financial markets. Back then, I didn't have any programming skills to speak of, and now I have very high skills. I think I'm probably one of the best programmers in the world at the moment, and I'm just running far below expectation because I've been constantly working on my own projects, and those projects went nowhere. So I finally get a job, I have the money, and now I can trade. This decision is really helped by the fact that the job market for software engineers is so poor. It has been ever since COVID, and it's probably going to remain like that for the next few years, and until the Federal Reserve starts raising rates. Actually, I think the job market is a bit better in Europe, but in Europe the salaries are poor, so it doesn't really make sense for me to apply there. In fact, I have to do this because I have a large amount of money, relative to my previous situation. I need to find some kind of trading system so I can compound it over time. And we're going to be working on a scalping system because such systems could give us very large returns in the shortest amount of time. Oh yeah, I forget to actually mention that. I've been writing these fucking these posts. Let's see. Oh yeah. This is really important. We're going to be working on intraday scalping strategies, and in particular, I want to start by quantifying the patterns taught by the S&P Capital and various other parties. And by that, I mostly mean Lance Bernstein. If you look at his scores, he trades these kinds of patterns. Let me just close this. Yeah, he trades these kinds of capitulation patterns. He also trades the news. Like he showcases various news-based trades. News comes out, then he actually uses the 2-minute bar system to just trail the stops along until they get hit. So something like this. But for our price action system, we don't want to trade the news. Instead, we are just going to look at the volume and move from there. S&P Capital, in particular, has a concept it calls stocks in play. Stocks in play are those stocks which are making very large price moves on very high abnormal volume. Oh yeah, well, one thing that also had a big effect on me are the machine learning papers. Okay, let me take a look at the VWAP. VWAP. Oh yeah. These two systems. Yeah. These two papers by Carlo Zaratini and Andrew Aziz have been very enlightening for me. Day trading, this particular paper. Uh, Is this the okay? I think over in this paper they are testing the opening. Okay, no, not this paper, but this particular paper is very enlightening. Here they are testing the open range breakout strategies, and they uh, they they use the stocks in play concept. And when they use when a stock has no abnormal volume, what happens is that the open range breakout system doesn't work. And the higher the abnormal volume, higher than let's say 3x, that gives highly abnormal returns, results limiting day trading to only stocks in play, even after considering transaction costs. Portfolio that consistent of top 20 stocks in play achieve a total performance of over 1,600% with a Sharpe ratio 2.8 and annual alpha of 36%. So yeah, that's why where I want to look for returns. And I'm not just going to be doing open range breakouts, but we're going to have a more sophisticated data trading system that's based on generative processes. Okay, and there's also one more paper. Okay, let's just take a look at what papers they published. There's also one paper. Yeah, this particular one. Volume weighted average price, the whole grail of data trading systems. And they found that this particular VBA strategy got an enormous return just trading the QQQ. And I want to test out that also the strategy, and we can actually enhance it by using what was written in this particular, let's say, SMB Capital trend days. We're also going to try to quantify this. We're going to combine it with our own system and the indicators that they are discussing here to get a better return. Like in this paper, they haven't actually been very selective on which days they are using this system. And instead, they are just using this particular system on every single day, regardless of whether it's likely to be a trend day or not. And if we are more selective, we could probably get a lot higher returns for this particular system. So yeah, SMB Capital, these papers. We're also going to okay. This isn't something that you have to do, but over in this thread, I've kind of actually looking into particular which platform I should be using to do backtesting and to execute trades. I got some very good advice from Post Trade Check, and he actually recommended Lightspeed and Lime. I've been looking into Lime. Okay, let's go into Lime trading. Lime trading. And in particular, they are marketing themselves to quant traders. Like they have direct market access, various collocations. Okay, we probably don't want that. But at the same time, we want to be wary of interactive brokers for a simple reason. I've been doing some research on them, and sometimes with interactive brokers, like let's say in this thread, like this guy is complaining that he had a 20-second delay at the market open. And I saw various other threads okay, not various other threads, but at least one more thread where people are complaining about second long delays with the interactive brokers. So we're probably going to be looking into opening an account with some but with some brokers that are suitable for scalping strategies. But he also did recommend here. Um, let's see. Yeah, he did despite suggesting these two brokers, he also did suggest that we start with the interactive brokers because they are the cheapest. And who knows? Maybe we won't be trading exactly at the open, so we won't run into these massive delays. Like we aren't going to be making a second long trades, but we're going to be holding the trades for like minutes on average, maybe even an hour. So maybe having a 100 millisecond delay wouldn't be too horrible for us. So yeah, it makes sense to actually start with interactive brokers. That's what I think. Uh, One final thing. I need to show you this book. Probably probabilistic programs. Progs. Not this. Bing is such fucking trash. Okay, let's try this. Rob. Okay, sorry, let me pause here while I find this. Okay, I'm tracking this down. Let's see whether this is it. Is it web PPL? What's going on here? Um, oh, yeah. It's the probabilistic models of cognition. Yeah. I think. What the hell? Oh, yeah. Probabilistic models of cognition. Yeah, it's by Joshua Tenenbaum. Uh, I'm going to put that in this link in the description. I think this particular book really shows you how to actually. It kind of gives you an insight into probabilistic programming from a programming perspective. Instead, if you approach Bayesian reasoning from the usual from the usual pathway, it's going to be like through hardcore math and statistics, and it's not what we're trying to do here won't necessarily make as much sense. So yeah, this is actually a very interesting book that kind of really got me interested in the field. So if you can, I recommend that you take a look at it. Let's see. Let me just note it. It's not progs, but prob mods. Okay, that's that. In general, the S&P Capital has a huge amount of videos which they are putting out for free. But having all these videos here just by itself won't really make you profitable. It's like suppose these guys are artists, and they are teaching you how to draw, and they have like 1,000 different videos on various techniques. Just watching these won't be useful to you at all unless you put in the practice. And we won't really be putting in the practice. Instead, we're kind of going to take shortcuts by developing trading systems. The analogous thing for art would be training, those diffusion models ourselves on our own style. and maybe using some 3D software like Blender to provide the labels for what we want the art to be. Pretty much all of their video titles are clickbait, but these guys are the real deal. They are traders. They're very profitable, but they're kind of using, the way they use the indicators is very ad hoc, and we can bring them into the 21st century using some more sophisticated methods. They aren't particularly sophisticated because we're going to be using we're still going to be using lookup tables instead of neural nets, and that's very embarrassing for both me and the research community. But who knows? Maybe 5 years, 10 years, we're actually going to get something that's much better, and we'll be able to use the GPUs to their full potential. So yeah, thank you for watching this. And in the next video, we're actually going to start off by programming the simulations on the GPU. Of course, we're also going to try them out on the host. And after that, we're going to go to massive. I'm going to buy the subscription for this and get the actual data for the stacks. And then we're going to fit the model to that. We are not actually going to be, fitting the model itself, but just the model hyperparameters. And by that I mean, let's see. I keep closing Escalator. What we're going to be fitting are these distribution lengths. Yeah, one thing that I also forgot is that we're going to have to figure out how we're going to be taking care of volatility. So yeah, besides volume, that's another thing we're going to have to figure out. Seasonality, volatility, volume. All of those factor into the price section. We're going to have to find a way to model it. So yeah, thanks for stopping by. And in this playlist, we're going to get serious about making money. We're not going to be trying to cause the singularity. Instead, I'm just going to achieve full financial independence here and hopefully turn my 100,000 into millions. See you soon.